And good afternoon, everybody, and welcome to the Horowitz and Company pop-up Q&A webinar for August 10th, 2020. I hope everybody's doing well. Hopefully everybody out there's power has been restored. I've been hearing a lot of discussion from people about how in the Northeast, it just had all sorts of problems with regard to power. And, down here in Florida, we were worried about the storm that was passing through. It seemed to just skirt us right by. But in New York, Connecticut, New Jersey, millions of people were out of power. So hopefully you weren't one of them. If you were, hopefully you got your power back. It's been pretty hot out, been pretty nice. We've been getting out a little bit on the boat just to let you know. Anything to keep our sanity through this entire pandemic. Hopefully, again, you're doing the same. But let's start our discussion and mention that this is for educational purposes only. It's not an offer or solicitation to buy any security. And of course, this is just not specific to any investments at all. Again, just taking your questions, talking about what's going on in the markets for educational purposes only. I'll also let you know that we have these recorded and we have those over on the disciplinedinvestor.com for replay. And it usually takes about a day. Within a day, we get it up on the site. So you'll be able to see it. Just go to the right side of the disciplinedinvestor.com and you'll see the information right there. And you can replay or fast forward. If you missed anything, it's right there for you. I'll also mention that this is all for you. So ask any questions that you like. There's a Q&A panel probably at the bottom of your Zoom area. You can click on that and ask any question that you like at any time. And we'll do our best to give you some reasonable insights into the question that you have at hand. And what we do with this is, again, it's all for the purpose of sharing in these very uncertain times. I mean, not uncertain from the markets because they seemingly just go straight up, right? But it's uncertain from an economic standpoint and, overall outlook for our personal lives and for our investments and our financial futures. And what we do is in the beginning of this, just the first few minutes, we talk about kind of what's going on in the markets, what's happening in the economy, some of the things that are really important that we're watching, what we're looking at right now. And then what we do is we ask your questions. So start piling up those questions so that we can answer any of them, whether they're on the new stimulus discussion that's going on, maybe some areas of the markets, maybe about the economics, maybe about some outlook that maybe, what's going on with all this, and we'll get right to that. So last week we were discussing, excuse me, last week we were discussing the whole idea of, waiting for this important economic data point that was coming out. It was the jobs numbers. And everybody was wondering, could we have another really good jobs number from the perspective of adding on jobs and adding them back from all the jobs that were lost over the last several months? And we did. We saw the joblessness rate move to 10.1%, which is not good, but it's a lot better than it was, a lot better than it was anticipated to be. We saw that 1.7 million people were added to the payrolls, back to the payrolls. That's good. At least people are getting back onto their jobs, working again. There's still a lot of question as to with the recent lack of the ability for a lot of places to reopen or reopen fully or to stall the plan that, how many people are really going to go back to work. And even if we get back to at a level of where we were before, quote unquote, normal, how many jobs are going to be lost in this whole process anyway? Because now a lot of companies were forced to do things. We heard as an example that there were various areas, for example, great example. So you have butchers and you have meat processors, and specifically in the area of poultry. And you have Smithfield and a few others out there, but they were looking to, instead of having human butchers, have robots start coming in, because robots aren't, we're not worried about them having an illness or really worrying about a vacation or time off or any of this, and not a problem with social distancing. We don't have that when it comes to robots. And if they could do the job just as well, maybe even a bit better, with no benefits, right? No worry about rehiring, bringing people on and educating them and teaching them and training them, then maybe it's a good idea. So what this did was this whole virus and pandemic was accelerate some of these features. And as we're seeing that these features are being accelerated and adopted by many companies, you have to wonder how many jobs are actually going to be lost in a broad-based manner from some of this. So this is really an area that is unknown. A lot of people are speculating as to what it's going to really mean for the economy long term. While companies may be able to actually do better and possibly even increase their net earnings over time with an infrastructure and development cost factored into it as they amortize that over time, the question remains, well, if we don't have people working, then they can't spend. So will this advancement, will this change and this benefit from, let's say, robotics or AI or anything related to greater efficiencies without people working, because now the job can be done by somebody else? And we know things like the copy boy or the switchboard operator no longer. We know that the traditional quote unquote secretary that would type out letters is not something that happens anymore. And this is just the evolution of business. And what's happened in the last several months is a compressed cycle in that evolution, where we have the necessity of actually having to do things like what we're doing right now, which is a meeting that's virtual, that is being adopted and utilized significantly by many people across many different industries, allowing for a one-to-many discussion and the ability to communicate without the use of a plane that we all travel to, get into a conference room and stay in a hotel and then go out to dinners and lunch and breakfast, etc. So there's certain areas of the economy that are going to be destroyed by this, and there's certain areas of the economy that will be helped. There will be a big shift, and then it'll probably move back a bit when some of this is resolved, whenever that happens. But the economics right now are still slowly but surely getting better, and that's a really good thing. The question is, how much further is it going to go, and are we just going to level off right now if, in fact, we can't nip this pandemic in the butt quick enough to really get things back to true normal? And when we look at market technicals, I think they're pretty strong still. Drops are being bought. We're seeing a significant rotation going on. There's some chinks in the armor, I would say, right now, where you see that the high-flying cloud stocks have been coming down pretty significantly, getting hit pretty hard after earnings. If they don't meet expectations or even don't exceed them dramatically, because the expectations are that these companies that have been powering ahead, and the thought that companies that are smack dab right in the middle of the benefit from this pandemic and the shift to technology, the shift to online, the shift to virtual, and all the things in between, if they're not really making it now, when are they going to make it? So if they don't do really well and exceed all expectations by a serious margin, what we're seeing is that many of these companies are dropping 20, 30% on earnings. We're also seeing a pretty good deal of, I would say, pretty healthy amount of price upgrades happening. Now, whether it's healthy or not, the upgrades that are going on, they're just happening. Day after day, we get a new upgrade on Apple, a new upgrade on Facebook, a new upgrade on Microsoft. And, the list goes on, not only in technology and name brands that we know about, but we're seeing this because what's happening is that markets are moving away from the values, the pricing where analysts have them. So if an analyst has a buy rating on a stock and a $40 one-year price target, and it's currently trading at 47, something's out of whack. So they need to adjust their price to meet the market where it is at this point. And it's a mechanical process. It's not really anything more that they're really adjusting, because we've seen stocks also be downgraded, but the price target is held, which is a little bit weird, where you downgrade a stock and a company on a variety of different measures, but you leave, or possibly even crazy as I've seen this too, where they raise the price target because they need to meet where the market is at this point. So what we're seeing is that analysts are really caught flat-footed because what they did was they really dropped down the estimates very significantly. They had no visibility. We talked about this last week in this very low bar, right? So, okay, that set the stage for companies to beat. And with the environment that we have with massive liquidity, low interest rates, and this whole euphoria that's being focused on the markets because people, they need to make money somehow, so they might as well try their hand at playing the market, which is creating significant bubbles that is being enhanced and helped by the Fed. And you know this story. This is nothing new. We've seen this before. And what's happening is that analysts now feel that they need to catch up. They need to start raising their prices because, wow, the market raced ahead of them. It's not that they really believe that the price value is that much further ahead in the future, but you know what? They can't fight it at this point. And they're like, you know what? If it's that far off, we'll raise our price target to somewhere in the vicinity of where it is today. So right now, we're also seeing a few really interesting things that are playing out. This rotation, it's been on and off, kind of, comes and goes, ebbs and flows, where we've seen it goes from the pandemic plays, those names, like Zoom, for example, is a great example of a pandemic play, and maybe even some of the biotech companies and some of the technology companies behind some of this, to the stay-at-home plays, to the post-pandemic plays. Post-pandemic plays being back to the airlines, the banks, the cruise lines, the hotels, the restaurants. We kind of been going back and forth in and out of this. All of a sudden, there's lower numbers that come out over a weekend or over a couple of days in places that are the hotspots like Texas, California, Florida, and the Southeast. And all of a sudden, everybody's like, well, maybe we got ahead of this now. And everybody rotates, and we see the technology shares, like we saw today, sell off. Same thing on Friday. And all of a sudden, the money starts moving and swashing over into not cash, but into these other ones, where we saw Royal Caribbean report results today, which was pretty miserable. Stock was up 10%. And all the other airlines and hotels and post-pandemic plays were really in fashion today. Whereas technology was sold off. The Dow Jones Industrial Average was up 350 points today. The NASDAQ was down 60 points today. Kind of a weird situation. Small caps did really well. And a big part also of this is that we're seeing that the Fed continues to press on the accelerator, and that's impacting the dollar. And I got a chart I want to show you here, right here. So this is what's going on with the U.S. dollar. The U.S. dollar has really spiked up in April, end of March, April, and we're seeing that big line on the top where we got that big spike because everybody was running for cover into the safest currency that was out there. Listen, let's not be in any of these areas around the world that are risky, that could maybe devalue. Who knows what's going to happen, how far this is going to play, where this is going to go. And then slowly but surely, as the Fed came in and said, you know what, we're going to put X trillion dollars on the table, and the government came in and said, you know what, we're going to give $600 a week. We're going to do all this. Well, what happened was the dollar started sinking. In addition to that, the other problem you have with the dollar, it's multifaceted. The first thing is the Fed is all in, right? They'll do whatever it takes. But the second part is that the outcome of the global condition related to the pandemic has hit the United States harder than anywhere else. Yeah, we could say that maybe Brazil is hit pretty hard. We're seeing South Africa come up pretty well, and Latin America has been really hit. But what's happening here is that as this is occurring, the probability that's being assigned to this is that the U.S. economy is going to need a lot more stimulus to get us out of this. It's going to take a much longer period of time to get back to where we should be, wherever that was. And we've seen the dollar just this year sink about 3.5% since the start of 2020 to where we are now. And in addition to that, what we're seeing is that from the high to the low, about a 10% drop in the US dollar. That has favored many of our positions in our portfolio, like foreign stocks, emerging market equities, really done very well for things like foreign bonds, small caps to a degree recently. It's also helped out areas that are non-dollar denominated in any position, like commodities, or that are are priced priced in respect to the dollar. So commodities have been doing very well. And we've seen that gold and silver and even platinum and copper and even the ags, we're seeing some inflation kick up because of this. So people are running towards the commodities, which is finally starting to pay off. Multinationals also have a tailwind when it comes to this. This little bump that we saw on the bottom, where you see this move to the upside, is one of the other reasons that technology and the big cap multinationals had a little bit of a drop back. As we see the dollar comes up, this could be problematic for them. So when we look at the overall dollar, you have to really put that in perspective as to how it plays for the overall economy domestically and internationally or foreign. Now, one of the things we have also is fiscal stimulus that's been in the spotlight. And as has been the case and will always be the case with this setup, with an uneven amount of representation in Congress and differing viewpoints from one political party to the next, we couldn't get a deal done. We couldn't get anything done when it came to this next round of stimulus that was going to be required to extend the $600 per week unemployment compensation, as well as the maybe the foreclosure and eviction moratorium that was put on, possibly something to do with mortgages, the student loan monies, more money for PPP and small businesses, and a variety of other things that were involved here. So what happened was that over the weekend, it's always over the weekend, by the way, over the weekend, President Trump signed a series of executive orders and memorandums. In the news, they're talking about this all being executive orders. It wasn't all executive orders. Some of it was things that he would want considered. They were memorandums that said, you know, we would like to look at the potential for deferring and delaying evictions. What can be done about this? Please look into this. Signed, Donald J. Trump. And that was a memorandum. An executive order is much different. An executive order usurps all forms of the process. And whether you like that or not, it's there. It's been used by the last few presidents to a degree, much more than ever was used before. But now neither side can bellyache about it because the other side's used it dramatically. Well, right now, there was the main thing that was important to recognize was the $400 per week that was now being put back into the unemployment, the federal subsidy for unemployment, and that was signed in as an executive order. However, bit of a mixed message. And the mixed message was that there's going to be a total of 400 as opposed to a total of 600. And the 600, if you recall, was paid for directly by the federal government. This is going to be a split of 300 and 100. 300 will pay by the Fed. 100 has to be paid by the states. Now, here's the problem. States have all sorts of problems with balancing their budgets right now. It's a terrible situation. They've been whining and moaning about all the problems. Now, we could probably assign a lot of the blame to how bad their budgets were even before this pandemic broke out. But let's put that aside for a second. Because on top of whatever pain they were in and however bad they were doing managing their budget, they're a lot worse right now. And because of that, the question is going to be, if it's reliant on, if employees, unemployed persons, are reliant on getting an unemployment compensation enhancement for the federal government by the states kicking in $100 per week, and if the states don't agree to it, like Cuomo did in New York, says he's not doing that. He doesn't have the money to do that. And if other states are having a lean time because they're not getting all their unemployment payments in because, you know, obviously there is a lot more money going out than coming in right now. And if that is the case, we may have a kind of a mixed message about what's really going to happen here. So first of all, let me just back up and just say this. I think that what President Trump did was try to push the envelope and press and call the bluff on both the Republicans and the Democrats to say, hey, you know what? You can't get anything done. I'll do this right now. And they're going to get all in a tizzy and talk about how it's unconstitutional for the executive orders, and this can't be done and that can't be done, but hopefully bring it back to the table. And if they can't get themselves back to the table, at least there's something here. So it's messy, though. It's very messy. Because now if the states are going to give the $400, well, the total of $100, and the federal government's going to give $300, they probably have to come with a different program. And a lot of the states are having a difficult time distributing, accounting for, and even dealing with the entire unemployment situation with millions of people being unemployed. And on top of that, it's going to be questionable of what happens and how you actually do this. It's going to take months to get this money out. Then we have a payroll tax deferral, which is also a little messy because we're not sure if it's going to be forgiven, if it's going to have to be held, and what happens in the future if payroll taxes are not withheld, but yet an employee kept that money and therefore is now going to not necessarily have the opportunity to pay it back in the future, or the employer is going to be responsible for it. Again, a little bit messy. And then we have the foreclosure, eviction deferral, student loan interest deferral. Those things are part of this whole mix of executive orders and memorandums that are going on. So something to think about. We're going to get to the questions in a second. Please do me a favor, load up your questions. We have no questions today. Usually we have so many questions that it's hard to even go through all those. So I'm sure you have questions on your sectors. You have questions on the outlook. You have questions on what's going to happen with the economy, all the things that we talk about. Bottom line is there is a mixed market question about all the things we just talked about right here, right now, in terms of these. I think, if you want my opinion, I think this will have to push the Democrats back to the table because this is much less than they wanted. They wanted $3-point-something trillion. The Republicans are talking about $1.2 trillion. And this is not even at that level. This will maybe get us to a point of possibly next couple of months if we can actually get any of this money out, if the states and the federal government can come together and get this out. So, the bottom line on this is that there is a significant amount of question. I don't know. The markets haven't really been bothered by anything right now. They're much more focused and laser focused on the money that's come out of the Fed and the liquidity there. So any questions you have, no matter how small, how big, how insignificant you may think it is, it may not be. It may be the best question that was asked since we started doing this back in March. So do me a favor, ask those questions on the not in the chat, but in the Q&A panel. I'll mention two other things as we get these loaded up. And this is all about your participation. So please make sure you know that it's all about you and helping you out with your situation. A couple of things I'll mention here that if you haven't had the opportunity to listen to this week's Disciplined Investor podcast, we had a great guest. We had Keith McCullough talking about quads, and we talked about risk ranges, and we talked about the old wall and a lot of really interesting things. He really challenges what is going on with, we'll call it mainstream financial media these days. And then on top of that, last week we had Ben Hunt on. And Ben Hunt, we talked a little bit about behavioral finance. We talked about the Kodak situation a couple of weeks ago, which is imploding right now, which we talked about it being a grift, and it was a crazy situation. So I think that there is the situation that is developing with all this loose money right now and all this questionable behavior is finally starting to come home to roost with what happened with Kodak and some of the potential theoretical, maybe insider trading that happened with regard to the $750 million loan that was utilized. Big announcement that there was all sorts of weird stuff that went on. All right, let me get to some questions. Just a moment. Let me kind of get my place back into where I want to be here because I lost my place here. Okay. First question comes from David. He says, what is your current view on precious metals? So, we did see that precious metals, we saw a pretty straight line up for example, gold and silver. being two of the majors that people look at when they talk about precious metals, and silver has been doing a lot better than gold of late in terms of percentage return. I mean, it's really a thinner traded position, less widely held. Also has some industrial components to it and uses for it. So I think there's a lot of people that like that for a reflation trade, and that's really what's happening right now. And there is a significant amount of interest in it because of what we talked about, the potential for all this excess money in the system, liquidity between not only the United States, but around the world. And that creates potential inflation. We're starting to see lumber prices and food prices start to move up significantly. And if you haven't noticed, things are costing a bit more in certain areas. So this whole idea of an inflationary backdrop for what's happening, an alternative to the dollar or other currencies, because there's a question by a lot of people about how safe is my currency with these central banks spending in the trillions and trillions of dollars. And then, of course, we're seeing that the debasement and the desire to debase currency valuations due to the fact that it helps buying power. This race to the bottom, well, it helps buying power for others that are buying our goods. But this race to the bottom, it's a real problem. And a lot of people are thinking that there is a longer view on precious metals that kind of sat out of the party for a little while. So I do think there is some opportunity. We hold precious metals, whether it's in mutual funds, ETFs, or individual stocks, several individual stocks in the area of gold mining, the larger companies in the TDI managed growth strategy that have done very well. And we also have a position that is kind of constant that we've had for a while in commodities that we consider to be, a good pool. It has oil, it has silver, it has gold, it has, precious and industrial materials in there as well, plus some ags. So I do think there's an opportunity there. I'm not going to make a call up or down, but if you think about the backdrop and you think about what's going on with currencies around the world, that's why Bitcoin's moving up as well. Alternative currencies, which precious metals sometimes fit into that category, is something that people want. Next question comes from Michael. Would you be a buyer of IAU and silver going forward? And if so, what percentage of your portfolio? So I'm not going to give you exact advice on specific investments like this. I'm going to talk about silver as a classification or of a sector, or precious metals as a sector. Somewhere between 2 to 5% of your portfolio in commodity related is probably what we see. It could be a little bit hotter right now. You probably have some run up if you were in, let's say, maybe in gold straight up or silver straight up as that position. But generally speaking, diversified position in precious metals or commodities, 5% position of a portfolio, depending on where your risk lies, I don't think it's an unreasonable thing as a small position, a reasonable position to have. Aaron writes, he says, I can't tell you how much I look forward to both your podcast and this pop-up. I can't imagine the work and dedication you put in. Thank you very much. Appreciate that, Aaron. And yep, we are safe here. So that's all good. Alex says, I'm starting to invest about 5% of my investment cash back into the market each week, so it's done by the end of the year. Do you think that's a good idea, or should I accelerate it? So I'm assuming that you have cash, Alex, for one of two reasons. You have cash just because you have cash and you've had cash for a long time, or you have cash because you recently cashed out because you're worried about things. So 5% on, I think I've talked about this concept before a few times, and I want to make sure I'm clear on this. So there's several different types of dollar cost averaging that you could do as we see it. One is a strict time-based, which is what you're doing every week. 5% of your money is going back into the market, diversified along your portfolio, right? And then you have another alternative to that, which is opportunistic. And opportunistic, which we use on portfolios that have a similar circumstance to you, where you're out of the market, whatever the reason is. Maybe you just got an inheritance. Maybe you were out for some reason. You decided to get back in. You sold a property and you have some excess money. You sold your business, whatever it is. Opportunistic looks for those opportunities where things move down, not just down 1%. I'm not talking about that. I'm talking about, you find those places that you see a move down and you reinvest into those areas that are more value oriented for the current environment. So if you see, for example, if you're doing it weekly, but I'm going to talk about monthly for a second here. If you do it monthly and you see that, we'll stick on the precious metals discussion here, that there was a big drop for some reason in oil prices and commodities, and that is an area that looks like it had a decent run, but it's hitting a bit of a wall and it dropped down, and there's better value as things are moving up on the other side. Well, take that position in there. So look for your opportunities where to invest and hold back some money for when those times break down. If you want to have this 5% of your investments back into the market each week, I have no problem with that. But what I suggest is both a time-based and opportunistic-based way of investing. And that's the way we do it for new money that comes in that hasn't been fully invested, or that people don't want to be out necessarily in our 1 foot in, 1 foot out concept that we've talked about several times here. So I don't have a problem with that at all. If that's what you want to do, if you're young enough to withstand the risk, I have no problem. Pick your points, I think, is really good when you're doing that, if you can, though. Raymond asks or says, tough to ask a question right now. I feel like I'm in limbo. With that said, what are your market projections, most likely case, worst case, best case in the next couple of months, and when PPP shuts down? So PPP kind of shut down already. There is some money left over, but really the people that I think were looking to take the money that was available last time, and that significant amount of money to pay for their employees when that was like an 8-week program, if you think about it. You could get 2.5 times the salaries. So we're talking about 2.5 times, so 2.5 months of salaries. So if you think about when it started, that kind of ran out in May, maybe June. So then the rehiring started when everything started reopening again, and then it started to slow down a bit. And we're seeing that there's a lot of talk about new layoffs. Really hasn't hit very much right now. But you say you're in limbo. This is the whole concept that I talked about. It's never really a right time to invest, because if the markets come down and you're sitting in cash, you're thinking, you know what, I was right, and it's going to probably come down more. I'll wait. And then it moves up a little bit. You're like, I'm not investing now. And then it could run away from you, just like what happened in, let's call April. My projection is that markets are overvalued right now, but there are some good places in the quote unquote markets that are not so overvalued. At the same time, I think that, looking at a diversified approach, looking at like having a position in foreign markets is better value than U.S., but I wouldn't count out the U.S. So you want to kind of be in a positioning where you have the opportunity to make decent money on areas that have the opportunity to still see a lot of growth, potential real estate in certain areas. Also in the emerging markets, I see there's a lot of opportunity to come back in a big way there. And on top of that, you want to look at, what are your long-term goals here? Because I think, if you're in limbo, the question is you're scared. That's what you're saying, I think, Raymond, right? I think you're saying you're scared, which is fine. We're all nervous about what is going on right now, because things don't make exact sense when you really try to pin it down with what's happening, except for the fact that we know there's an incredible amount of stimulus that's being pushed in the market on a regular basis. That makes sense. That clarifies a lot of things. So when is that going to end? I don't know. It hasn't really ended over the last 10 years. Doesn't look like any government around the world is really willing to do what they need to do to clear out all the junk and get rid of all the zombie companies and then start anew with a much stronger base. No, they're not willing to do that. So I think that the best case scenario is that we continue to see a bit of a ride throughout the end of the year. The worst case scenario is that we have a significant correction that comes in when reality hits a little bit, and you have to be set for that, which I think our portfolios are. We're riding both sides, 1 foot in, 1 foot out. And I think you should think about that as well. Raymond, if you can't make a decision, you should contact somebody that can help you, give you some ideas on what may make sense for you for the long term. I think that's a really important part of this process. If you're in limbo and you're kind of like frozen and you can't make decisions, that's the time when you go find somebody that can help you. Hope that helps. Nick says, with equity, bonds, and the dollar all seeming risky, where would you put your money? Say should we move to cash into currency funds such as a variety of different things, or stay in commodities? Well, I think what we've learned over the last while is that, when the Fed is having rates as low as they are, it raises all ships. So when they're risky, bonds are risky if you're in the wrong positioning. There are positions that you could be in, like when we create a portfolio and we dedicate a portion of that to bonds, there are not just the blanket area of bonds that we want to be in. We want to be in certain duration. We want to be in certain classification of whether it's corporate or treasury or sovereign. Do we want to be in junk bond? Do we want to be in long maturity, short maturity, domestic or foreign? Do we want to be, we want to look at grade? What's the quality of the bond? So I think that if you've heard me say, and you think that I was saying, and maybe I did project this, that equities and bonds and the dollar are all risky, or unless that's your opinion here, I think there are places to put your funds that have a less, I would say, risky exposure than just seemingly equities or bonds or the dollar. And if you put it together properly, what happens is, you're going to have some risk in your portfolio, but shape it in a way that has less risk than just simply the equity universe, the bond universe, or just simply commodities. So I don't think you should stay only in commodities. I think that's a much more risky play when you're undiversified and concentrated. So, hey, Mike, we're not going to talk about any individual positions. Question was about IGM. So if you want to reshape that into maybe a little bit of a different question, we can go through that. Let's see. Kurt says, what happens if the states refuse to pay $100 to the 400? Does all the money go away? Michigan is already projecting a $3 billion deficit. Well, that is the question, isn't it? I think there is a significant amount of question and confusion and concern about this, because it does appear, at least it appears from what we see, that the extra $300 is somehow tied to the states doing it. And I kind of wonder, if the knowledge was that states are having a real big problem, how are they going to chip in any further money? I don't know how that's going to happen. Now, there is some money that the federal government gave to the states, or, through this, there was some allocation of monies. So I guess they're trying to use that up, but why didn't they just use the federal money anyway? I don't, again, a lot of confusion. It does seem that you're right, that if the $100 isn't kicked in by the state, that the money is not going to be paid. If the states put it $50, will the federal give $150? I don't know. Seems like from what we saw, it was $100, $300. I don't think it was extremely well thought out. And it seems like this is what I was talking about before, about this confusion. Carl asks, or he says, hi, Andrew. In the past years, I used to hear a lot about the looming underfunded pension crisis in this country being compounded by demographic issues, for example, retirement of baby boomers. Given recent events, the pension problem should be much larger now, yet I don't hear anybody talking about it. Any thoughts? Yeah, they're much worse. And you're not talking about it because we got, unfortunately, things that are even much worse than that is taking up all our time. Because that seems like a smaller problem versus what's going on with the state, or the $3.5 trillion budget deficit that the government of the United States has right now, or the deficit of the world and the amount of debt, and the $7 trillion that is it 7 now? I guess it's maybe 5, maybe 5 trillion. The amount of money that the Fed balance sheet has in terms of debt outstanding. So that was kind of slipped under the cover right now and just kind of put aside under the rug. And it's put aside right now, but it's a big problem. This is a underfunded pension crisis is continuing, not only from a corporate standpoint, but man, the states are not only hurting from all this unemployment they have to pay, and the lack of tax receipts they're bringing in, and the lack of business that's going on, and yada, 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 all the other things. But man, they have a big problem because of what's going on with their pension plans right now. And that's another reason why a lot of these pension plans have been forced into being much more aggressive with their portfolios. The problem is when you start calculating the underfunding, the lower the interest rates are, the more underfunded potential they have. Because to meet those requirements, they usually have a significant amount of bond exposure that pays on a regular basis, so they can calculate with a safe margin of, okay, if we buy these many bonds at 4.5%, we'll be able to pay the retirees from this tranche of retirees for their lifetime, no problem with the other monies that are coming in. Well, problem is that with a lower interest rate, it exacerbates the problem, because now they can't really plan well, and the underfunding problem gets even worse when the interest rates go lower. So big problem. I don't think you heard anything wrong there. We have a question coming in. It says, I'm being laid off at age 59 and a half. Sorry about that. I have a small 401k with a loan against it. I have asked them to move all equities into a stable fund, AKA cash. Will I still need to pay off the loan? You'll eventually need to pay off the loan, yes. If I don't know if you're asking if you move the money from equities to stable, will you still have to pay off the loan, or because you're being laid off, will you have to pay off the loan? But yes, you will continue to have that liability on the loan. And if you somehow take out your 401k, it'll come out net of the loan. So you have to pay off that loan eventually. You're paying it back to yourself. But yes, that will have to be paid back. Hopefully that helps. Next one up. S&P 500 was 3,360 today. 3,386 was the February 19th low on February 19th. The low is March 23rd of 2237. What does this mean? It means that most of the recovery happened. The S&P is positive for the year. An amazing thing when we have a 50% reduction in earnings on a year-over-year basis, not to mention a 12% hit to revenues. It means that we are at a significant peak in multiples right now, which doesn't seem to matter. It means that this whole thing has actually been a blessing for many companies. It means that there is this incredible amount of dysfunction going on between the economy and the stock market. It means there is creating a much greater moat between the haves and the have-nots. It means that there's a lot of people hurting, and a lot of companies hurting, and a lot of businesses hurting, and a lot doing really well. It's creating a major problem. So what that means is we are 20 points away, 25, 30 points away, give or take, from an all-time high on the S&P 500 without earnings catching up. It means that there is a significant amount of hope and excitement and exuberance about what the next number of years will bring. It also means that the top heaviness of the S&P 500 with the Microsofts, the Amazons, the Facebooks, the Apples, the Googles, the Home Depots, all those companies are really doing well, helping to inflate the prices. So it means that an incredible amount of work was done to get us back to this point. All right, let's bang through these. Next one, I think that gold will go up because of the global massive money printing, COVID-19, and China-U.S. tension. However, I can't visualize that U.S. will go down the path like Venezuela or Zimbabwe, because the EU and other developed countries are printing billions or trillions of dollars as well, and they won't want their currencies to go down the drain. I feel like once COVID-19 is subsided, the whole world will pretend everything is back to normal. Any debts generated during the pandemic will be forgiven. Advice? I think everybody thinks that everything's back to normal already. I mean, we basically covered it all up and papered it all over, didn't we? So I think that there is this idea that there is a no, I don't think we'll go down the Zimbabwe. Well, we're going down that way. I mean, if you look at the currencies and what's happening to other assets, we are debasing the currency. The EU is euro. Everybody's debasing at the same time, though. That's why it's not going to hell in a handbasket overnight, the dollar, because everybody else is doing the same thing. But the bottom line is that you have a situation where I think that basically that the money that has been put on the system has created a bit of a a blurring effect to reality. That doesn't mean things are bad, not at all. But it's blurred what's really going on. It's covered it up. One way or another, money had to get into the system. Liquidity had to open up. We had to have the credit market start functioning again. And that happened because of the Fed. Money had to get into the pockets of individuals. That happened with the fiscal, with the Congress and the president that they put together that fiscal $3.5 trillion package. So one thing, when things go back to normal, when it subsides, yeah, the dollar will strengthen again once things get a little bit back to normal, if we can bring our economy back. And everybody's going to go along their way. I mean, that's what happens with finances. I mean, do we remember, 1987 crash? I remember it, but it's like looking back on it, it's like that wasn't a big deal. It was in a little while. But during it, it was hell. What about the 2008, 2009, 2010 period? Kind of ugly, painful. But now we look back on it like, oh, yeah, okay. That's done and over with. So I think you're right. But I think at the same time, we have to look at this as just one more time that the Fed's stepping in. I don't know how much longer we can keep on increasing our deficit, our debt, and all that. We'll have to see. There's a question coming in from someone says, I'm being laid off. Follow-up question, okay? I have an HSA. Can I roll it into a self-directed IRA? I don't know that answer. I think Kevin's on the line. Maybe you can look that up and find out for us in our view. It's, can we roll an HSA over into a self-directed IRA? Let me come back to that. Michael asks, there have been a nice run-up for the artificial intelligence or AI funds and ETFs. Do you see that continuing or maybe temper performance going forward? I think there has been a lot of, I personally think there's been a lot of, what is AI is the big question. So something that John Dvorak and I talk about is what is AI? What does machine learning really mean? What is this? Is it really going to be true artificial intelligence, or is just machines, with programmers coming up with ways to create a significant amount of answering of questions, whether they're bots or robotics that can do the jobs of, again, with programming. I think there is an opportunity in this, but at the same time, I think you have to be selective as we get through this process. The hope, listen, in biotechnology stocks, everything started rising in the hope that someone is going to have a vaccine. And then what happens is that we see that it narrows down into what the proper candidates that are really making the charge. Now you'll see a left fielder come out from somewhere, and you'll see that there'll be an opportunity that arises that we didn't know about before. The same thing with AI. But I think you stay with the main companies that have been really proven they have something going, and I think you'll be in good shape. Of course, there's risk with that, obviously. Michael says, I have to also say thank you for your dedication with this pop-up, your podcast, and your trigger charts webinars on Friday mornings. Yeah, thank you very much. I appreciate that. This is from Nico. He asks, any thoughts on the DXY, the Dixie, the dollar? Overall, the dollar strength in the short to medium term. So let's just kind of go to that chart again and look at that. So there's a nice base that, well, I shouldn't say nice base. There's a base forming. It's not a great base. It's a couple of touches. I think a couple more retests of this line down at the level, which again, this is a percent change chart. If you look at this from a different aspect of the price chart, it may be a little bit different. But I think that if we start to see that there are less cases, maybe if we see that the economy starts to kind of like stabilize and not slow down again, we don't have the threat of closures. I don't know, maybe school openings and nothing really bad happens. I'm speculating here. You could see the dollar strengthen. The weakness on this is all about the excessive amount of activity by the Fed, their kitchen sink approach to all this. And then on top of that, what's going on with regard to the rest of the world. They're having a much better situation. I mean, we had 0 cases in New Zealand, 0 cases in certain areas around Europe and in Asia over the last few days. And, we're still plowing ahead with all sorts of record deaths in Florida and all sorts of problems. And I don't know about you, but I'm panicked about going out, right? So you go out and you kind of like just walk around people, you stay away, you're constant alert. Feel like I'm playing like a roller derby, just watching for somebody to come out of the woodworks and slam me down and breathe on me. So the bottom line on this is, I think once we get beyond this, yes, the dollar will pick up a little bit, and could get stronger. I don't know how much. That will be a tailwind for certain areas, but a headwind to our multinationals and all the things that have been working right now. Now, last question coming in from Mike. This week's Barron's had an article talking about bonds are not really a place to protect in the case of equity markets moving downward. And the author mentioned it would be better to replace your bond position with inflation-protected holdings. Historically, you have been better off over the last 70 years. I mean, also bonds, there are tips, right? Treasury inflation-protected securities, that's part of the bond universe. I think that, again, bonds on the long side could be problematic, especially with the weakening of the U.S. economy. If, in fact, you do see another quote-unquote massive market correction. We saw this. We saw that bonds on the long side got smacked. You saw the junk bonds get whacked. You saw that there was a big problem where there was the situation with regard to anything that was not sovereign short-term got obliterated. Now, the only thing that happened that solved that problem was the Fed said, you know what, they're coming in to buy bonds. They didn't even have to buy the bonds. They didn't even do it. They just said they were going to do it. And bonds magically started running up like crazy. Everybody's like, get me into bonds now because I want to get ahead of the Fed and they're going to be buying in a couple of months. And man, I want to get. And all they had to do is say it, and they solved the problem of the liquidity and the credit crunch that was going on. So I think respectfully, there is a place for bonds and there's a place not for bonds. I think that if we have everybody going to cash, everything goes to hell. So we're talking about short-term, long-term. Short-term, I think, yes, everything could get hit. That's why you want to be on the shorter duration, shorter maturity, higher grade, et cetera. High-grade corporates, sovereigns, tips, and obviously into kind of a portfolio that is more of a defensive in the bond side. When it comes to the longer term, I would say that, things that would be inflation protected holdings, I think you're talking about maybe gold and things of that nature. I mean, obviously that's where we have that in our portfolio too. I don't think it should be one or the other. I think it should be both. Let me get back to the question that was asked earlier from the listener and questioner that was losing their job. So Kevin took a look at this. It doesn't appear that you can roll your HSA into an IRA. However, you could continue to keep the HSA and use it for medical expenses now or well into retirement. As long as you use it for qualified medical expenses, then the funds can be used tax-free. So I didn't think it could be rolled in, but I did want to just clarify that. We're out of questions. We're out of discussion. So what I'm going to tell you is that Tuesday night, 9 o'clock live, and of course on your favorite podcast system. By the way, if you listen to The Disciplined Investor, if you listen to DH Unplugged, go over to iTunes or somewhere and give it a review for us. That would be really helpful. But other than that, if you have anything you want to talk about, well, listen to us on DH Unplugged. Put a question in on the Ask Andrew for The Disciplined Investor, and I will see you next week. And I appreciate you being here. Please tell your friends, tell your family. That's what we're here for, to do this as long as it takes to make sure that everybody's questions are answered. Thanks so much, and I'll see you again next week.